Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, I'm back here on the Paul Winkler, the Investor Coaching Show. Okay, so talking a little bit about various investment vehicles that might be out there. We talked a little bit about stocks. Now, I've talked about that all the time. Large companies, small companies, value companies. You know, why do we own stocks? Why historically have stocks actually outpaced inflation? Well, that's part of the reason we own stocks, because they have been the thing that outpaces inflation. It's because what is inflation? Prices going up. Who's raising prices? Companies. What do I own when I own stocks? I own the entities raising prices. And if we look at the historical return for large U.S. stocks, after inflation, take inflation out of it. After inflation, the rate of return from 1926 till now is about 7%. For small companies, it's about 9%. If we look at value companies, it's going to be somewhere in the neighborhood of 8 to 9%. Small value companies around 11%. And if we go to international markets, again, about 7%, somewhere in that neighborhood. Small companies, small international, about 10 or so, somewhere in that neighborhood. So we look at those areas of the market and say, well, that's well above inflation. Now, if I look at bonds and I look at fixed income investments, that's not what we hold them for. They are not a good protector against inflation. We can go back 100 years and we can see the Treasury bills, the rate of return is about 0.4%, barely above inflation. And some periods of time it's negative. We look at bonds in general. Sometimes it's a little bit above. When you're in a declining interest rate atmosphere, kind of like what we've had over the past 15 years or so, interest rates have come down some. People forget that back in 2000, you could buy you had money markets, 5-6% return. I remember when I got into the insurance business and we had annuities paying 8 to 9%. And you could actually illustrate high interest rates, and people thought, oh, this is going to be the case forever. Now we look at interest rates at like 3 and we go, wow, I guess that wasn't something that was going to last forever, was it? Well, when interest rates go from 8 to 9% down to 3, what happens anytime interest rates go down, then what happens is you'll have bond prices go up. But the reality of it is if you have interest rates go back up again, which is what happened in the past 15 years, you had that increase again in interest rates just slightly. And that's what everybody's complaining about right now, right? They're complaining about that mortgage rates are high. They're complaining that you're getting a mortgage and it's 6.5%, but just a few years ago, we only had 2% mortgage rates, right? And some people actually got in at 2%. That's why real estate is frozen in so many places. It's because people, they don't want to sell their house, because if they sell their house, they lose their 2% mortgage. Well, when those interest rates go back up, that drives bond prices down. So it can reduce the rate of return on fixed income investments. This is just the way this stuff works. So you can have periods of time where bonds have very, very low rates of return. So typically what I'm doing is, when somebody is younger, especially, we're holding more stocks. As they get older, we do add bonds, but we don't go crazy adding bonds. And that's the reason. Even in retirement, if you look at the Bengen research, he said hold no less than about 50% to 70% in stocks when you're taking income. So a lot of times you'll hear me fall right in the neighborhood of 60%. You'll hear that out of me a lot of times. But recognize that that's what happens. Now, what we'll see out there is people saying, well, you need an annuity to actually diversify you and blah, blah, blah. And investment advisors will muddy up the water quite a bit regarding this. Now, there was a well-known lady that does a lot of videos. You've probably heard Susie Orman. She does a ton of stuff about investing, just kind of educating. Some of the stuff I agree with, some of it I don't agree with. I'm not crazy about. But there was this guy picking apart something that she had played, and I'm going to walk through both sides of this, because here's what she had to say, and then I'm going to have you hear what he had. Apparently, this guy is an annuity sales guy, from what I can gather from the video. But anyway, just check this out.
Susie Orman just brought down the hammer on annuities. Let's take a listen to what she had to say, and then I'll give you my thoughts afterwards.
Can I just do a very quick Susie school on why annuities are so bad?
Go for it.
All right. So Janet put in $50,000 6 years ago. It's now worth $68,300. So in 6 years, it grew $18,300. That happens to be only a 5.4% approximately compounded annual rate of growth, which is horrific
in today's market.
In the last 6 years.
And the reason she's saying it's horrific because it was an index annuity, which some investment advisors recommend as an alternative to the stocks because you can get the returns of the stock market without the risk. And it's kind of like this free lunch type of thing. I've seen the presentations that basically say, and I just recognize this guy was the Power of Zero is the guy that did this video. You know, so this idea that you die with nothing, I think is his philosophy, which is like, goes against what a lot of people, you know, as they get older, they want to leave some kind of legacy. So to die with absolutely nothing at the end, it's not typical. I've been in this industry 35 years. I rarely find people that love the idea of dying with absolutely nothing left over. I tell you what, I'm going to come back after this. I want to stay on task, on schedule, and I'm going to continue this video because she's basically saying this is horrific, this is a terrible rate of return, and I want you to hear his response at the other side of this regarding this take on annuities and what he thinks that you ought to do. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money. And rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. Hey, what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, back here on the Investor Coaching Show, I'm Paul Winkler. Okay, so I'm getting a little nerdy today, just a little bit, talking about various types of investments and, the idea annuities are a big thing out there. I was in the bank not too long ago doing a transaction, setting up an account, and I could hear the investment person behind me trying to recommend an annuity to the couple that was sitting with him. And I just shook my head. I was like, I just want to so badly turn around. No. Now, are there ever cases where they make sense? Yes, there are. Annuities were designed to be a distribution vehicle where you had a certain amount of money and you would get back interest and principal over a life expectancy. So basically, they were giving you your own money back, and the money would run out when you died. It was gone. That was the idea behind it. So if I had the example I like to use, $100,000, let's say that the interest rate was zero, just keep life really simple, keep it super, super simple. And let's say that you only had a 5-year life expectancy. $100,000, you got a 5-year life expectancy. You're going to get 20% of your money back. 20%, 5 years, you get all your money back. If you live 1 year and you don't make it to your life expectancy, you got $20,000 back. You gave them 100, you got 20, you lose. You basically 80, or your heirs lose, I should say. $80,000 goes to the insurance company, they win. Now, if you live beyond your life expectancy, let's say you live 10 years, you got $20,000 a year. For 10 years, that's $200,000. You gave them $100,000. You win because you lived beyond your life expectancy. Now, that's the idea. That's why an actuary is involved in setting up the pricing on annuity contracts. Very first annuity was actually developed like 2,000 years ago. The Roman government, and that's how soldiers were paid. You say, wow, okay, so this is nothing new. Well, what has happened is it's morphed into an accumulation vehicle, people using it for accumulation when it was actually designed to be a distribution vehicle. And the problem you run into is if you're a very young person with a much longer life expectancy than 5 years, you could be putting up with a very small distribution per year for the rest of your life that doesn't go up with inflation. Now, there are some weird products out there that do have an inflation increase, but they're capped, number one, A. And then the distribution is super, super, super low on the front end as a percentage of what you gave them because they know that they have to give you an inflation increase in the future. So I've never, in matter of fact, I never see them ever sold because the distribution is horrible. No, I've never even seen one in use, never. Now, if we look at that and say, let's say, well, what if they tell me they're going to give me a $50,000 income per year? I'm like, I'm good with that. Let's say that that's fine for your budget. And you have to ask yourself in 20 years, what's $50,000 going to purchase? Now, you may think that sounds great and it's not going to be a problem, but realize that in 1970s, an entire family could live off of $7,000 just fine. Now you need $70,000. So the reality of it is money goes down in purchasing power pretty doggone significantly over time. And you may be looking at that and saying, hey, that's a great income you guys are going to pay me if I annuitize. That's what that's called, annuitizing, having the insurance company pay you that income that when you die, the money's gone. Now, there are products to muddy up the water that will say, hey, you know what, there is some money that'll be left over for your heirs if you do that. But how do they give you money for your heirs if you die early? Well, they reduce the distribution amount. So they're always 100 cents in a dollar, as one of my old mentors used to say. There's never a free lunch out there. So Susie Orman's on there going to say, I don't like these things. They're terrible. They're a ripoff. Look at what the return has been over the past 5 years. She's telling this lady that she's talking to, and look at what the market did over this period of time. And you got, the market went up 30%, and you got this tiny fraction of that rate of return. And this guy is going to say, there's misleading stuff in here. And there is. But he doesn't necessarily clear up the mud at all.
So, number one, an indexed annuity is not a good investment because you only get a percentage of what the index goes up. You do not get the entire thing. That's number one.
Okay, apparently the real scandal here is that this particular annuity only compounded 5.4% per year over the last 6 years. Compared to the stock market, that's a horrible investment, right? Well, as Susie so often does, she's engaging in a classic apples to oranges comparison. Index annuities were never meant to be a stock market replacement. They're a bond alternative.
Now that's where he gets into bad water, in my humble opinion. Now, would I have a bond hold bonds on their own? This is where it's going to take a little bit of educating on investing, okay? So if I look at Markowitz, the guy that won the Nobel Prize in economics in 1990, he talked about how do you maximize expected returns for a given level of risk. Now, he says if you have no time horizon, you've got a very, very short time horizon, and you go all bonds in your portfolio, or you go all cash, let's say you put all your money in a money market account, that would be an appropriate vehicle for your emergencies because you just don't know when you're going to need that money. What a lot of people don't recognize, and a lot of times when I'm teaching financial advisors, I will point this out. On his frontier, I tell people it looks like an upside down Nike symbol. So I've got an XY axis, and I got this upside down Nike symbol. And at the very, very top right is where you have maximum expected return, but then you have maximum risk, which is stock markets. Now, risk being how much it can go up and down, how big the ups and downs can be of your investment portfolio. If I'm a young person, who cares? I got a long period of time, and I don't care about the ups and downs. I just want maximum expected return for that given level of risk, and I'm okay because I'm not going to be using the money for a long period of time. As I get older, I start to add bonds, and that brings down that return sum. but it also brings back the risk significantly. What people don't, and I have to explain this to investment advisors all the time when I teach, is that if you look at the bottom part of the curve, it goes down and then it curves back to the right. And you know, if you're just listening to me, you're not going to quite get this, but here's basically what the curve is showing us. If I go all bonds, I'm actually decreasing return because it's all bonds, but I'm increasing risk. Why? Because of interest rate risk. When interest rates go up, bond prices go down. So to use it as a bond alternative, you've got to assume that you want an all bond portfolio that makes sense for an individual investor. And it doesn't. In my humble opinion, it makes no sense because you're increasing risk without the commensurate increase in expected return. Doesn't make any sense whatsoever. So how do bonds? What should they, or how would we use them in an investment portfolio? Well, I would combine them with stocks. And the reason being is because it is the one place we get things that don't move in lockstep with each other. Bathing suit sales and winter coat sales. That's the idea. If you have a situation, and we go back through history, we go back 1986, we go back to 1991, we go back to 2000, the year 2001, year 2002, year 2008. You know, you go back to 1973, 1974. You go back in history to look at big downturns in the stock market. What we'll typically have is, well, the economy gets bad, the stock market goes down, then you have interest rates go down. Why? Because we've got to generate economic activity. We've got to get things to go back again. And because people get scared, another reason this happens is because people get scared and they sell stocks. They buy what? Bonds, which drives the price of bonds up and drives interest rates down. So there are a couple reasons this happens. Now, when that happens, when stocks go down and bonds go the other direction, that gives me someplace I can draw income from to buy me time for when stocks go back up again, which they always have. And I've got to have something that goes up in a significant way. So go back to 2002. Go back in time and look at various downturns in history, and you'll see that if we look at, let's say, let's just pick a couple of years. Let's say 2000. Intermediate bonds. When the stock market with the S&P 500 went down 9%, intermediate bonds went up 13.5%. In 2001, when the S&P 500 went down 12%, intermediate bonds went up 8% that year. In 2002, when the stock market, the S&P 500 went down 22%, the intermediate bonds went up 15%. In 2008, when the S&P 500, it was a big downturn, 37% return, negative in the S&P 500. Now, the bonds didn't go up as much as the S&P went down, but they did go up 13%. If I had an investment vehicle that was just like an annuity product like that, an indexed annuity, and you look at indexed annuities, what's the return tied to? The S&P 500. And basically what happened during years like that is no return because it was tied to the S&P 500. When the return of the S&P was negative, they basically took away all of the return and you got nothing. I mean, that's one of the problems that, I have whole shows where we talk about this, so I'm not going to get into this in detail why that happens. But that's the problem that you run into. You can't use it as a bond alternative. It makes zero sense to use it as a bond alternative because of how it responds during market downturns. It may sound good as, you need to have this diversification. And it gets me because so often I hear this stuff talked about, and I hear investment advisors say, you need to do this, and recognizing that they're not getting that this is not how it works. An investment portfolio, I want something holding value or going up. And that's why I don't put all my fixed income in super, super short-term fixed income in a portfolio. If I have it all in cash, yes, it's holding its value when the stock market goes down. And, I can pull income from that. But if it doesn't jump anything, it doesn't do any kind of a significant jump in value, it's not really helping offset the negative risk of the stocks. And that's the problem that you run into. Now, so, and the other problem is this, is that if I use an annuity as my fixed income source, and I use a commission-based annuity. Now, any of you have ever bought a commission-based annuity, you know what happens. You put the money in, there's a back-end surrender penalty for you to get out. You feel like you've just jumped in the Hotel California. You can check out anytime you want, but you can't leave because you've got this big hole of a back-end surrender penalty. I was talking to Jonathan, one of the guys. Jonathan runs he's out and works out in Murfreesboro some, and he the Gallatin office, and he goes, man, we were talking about this topic, and he goes, he worked for several banks, and they did a lot of annuity business. He says, I can't think of a single case. He said, in all the years that I worked at those banks, I can't remember a single case of somebody coming back to me years later and going, man, that was the best thing I ever did buying that annuity. I said, yeah. Me too. I was never a fan. The only time I ever recommended them was when I had somebody who was of advanced age and I needed maximum distribution, like the example I gave earlier, and I needed it over a short period of time and nobody was worried about anybody inheriting anything. And they weren't worried. They had a short lifespan, so they weren't worried about inflation. It wasn't a big deal. But when you're a younger person, and yes, 70s is a younger person because you could be around for 20, 25 years, or one of the two of you if you're married. Very, very high likelihood somebody's going to be around that long. And you're just basically going, I don't want to hand this money to an insurance company and just not have access to it anymore. I don't want to lose that liquidity. I don't want to lose that freedom. And yet, so often what people do is they hear these sales pitches and they think it's going to be a great idea, only to find out once they get in that it's not such a great idea. And back to the management of the portfolio. If I have half my money in stocks and half my money in bonds, let's say, and the half that's in bonds, I decide to use an annuity as the alternative. When I'm managing a portfolio, what am I doing? I'm saying, hey, you know what? Stocks had a really good year this year. So they're 60% of the portfolio. And now my bonds are only 40% of the portfolio. They're supposed to be half and half, let's say. Let's just use that as an example. Stocks had a great year, let's say, and now it's 60% and bonds are only 40%. I need to sell some stocks and buy some bonds. Well, if I'm using an annuity, what am I going to do when I sell the 10% overage in stocks? I'm going to buy the annuity, which is ka-ching, commission. Then when the opposite happens and stocks do poorly and bonds do well, and I have to sell some bonds to buy stocks, what do I have? Back-end surrender penalty. Then I buy stocks, and all of a sudden now my bonds are lower because a commission was paid out, and I have a penalty to get out, and I don't have the liquidity. And the bonds didn't go up in value like I wanted them to do to offset some of the stock downturn. Now, and I know this is complicated, but I wanted you to get this. I want you to get that when people are talking, they can really confuse the matter. And if this is something that, you're still confused to some extent, just as time you listen to what I teach and how I teach this stuff, eventually it starts the light bulb comes on and you go, yeah, this makes sense. Yeah, this makes a lot of sense. Because investing isn't that complicated, but it is made really complicated in order to sell products. And I tell people just stay away. The commission-based sales, a lot of times people will say things because it behooves them because their livelihood depends on it, really. I remember working for a guy and he said, just confuse the investor and then they'll be putty in your hands. And I thought, you're a jerk. I'm out of here. It's a true story. I'm working for an investment firm years ago, and no way. Got to get away from this. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.